Welcome back to the CRE with CBC Worldwide podcast, the podcast where we explore trends, both current and future, affecting commercial real estate. I'm your host, Dan Spiegel, Senior Vice President and Managing Director of Coldwell Banker Commercial. And today we're going to be diving into the state of the CRE market. Now, I know there's constant change in the economy, constant change in business, and all of that does impact commercial real estate. But here we'll dive deep into where we are in the recovery cycle for the real estate, what's surprising us, what's shaping the deal landscape as we look towards the end of 2025 and even into 2026, across looking at different asset classes, geographies, and so forth. Frankly, a lot has happened since we held our Coldwell Banker Commercial Annual Conference back in March, which we did hold in Texas. And our guest today, Lonnie Hendry, Chief Product Officer of TREP, was our speaker at that time. But that's now, gosh, what is that? Almost 6 months ago, 5 months ago. So I don't know if anything you certainly don't want to go back and revisit what you said then because it's probably all changed. But today we're going to talk about some of the shifts that have happened since then. We've had changes in tariff policy. We've had the big, beautiful tax bill. Oh my gosh, I can't. Speculation around interest rates, the Fed, so much is going on, all of which impact commercial real estate. So join me in welcoming Lonnie Hendry as our guest today. Lonnie is, as I said, is the head of analytics and technology solutions at TREP. He is also a fantastic host of the TrepWire podcast, which drops every Thursday. He's an instructor of real estate at Texas Tech University. And Lonnie holds a CRE, Counselor of Real Estate designation, which is one of the most prestigious designations I might mention in the industry. So congratulations to Lonnie on that. He brings a unique skill and perspective, both from data as well as just years of experience in business and real estate. And I'm thrilled to have him on the show. So we'll unpack what's happening across asset classes, geography, where deals are going. But without further ado, Lonnie, welcome to our CRE with CBC Worldwide podcast.
Thank you for having me. It's great to see you, and I'm looking forward to the conversation today. And yeah, definitely loved my time at your annual conference. But as you mentioned,
Yeah,
the world has changed since then.
it changes every day, frankly, but that's okay. It has changed since then. And we were kind of on your home turf when we were down in Dallas. So really, we appreciated you speaking there. And we'll catch up today on what's happened since then. So, but before we start, I always like to give our listeners a little background on our guest or let the guests explain the background on themselves. So, you can start whatever age you want and just tell us how you decided to focus on commercial real estate and what took you to the place you are today.
Yeah, it's great. And so I have a fairly unique backstory. When I was in college, I worked as a leasing consultant in my first kind of commercial real estate job. So I was going to school full time and started leasing apartments. And that was a really great career because I did a couple of cool things. Like one, I got a 35% discount at the property I worked at. So I ended up renting a 4-bedroom, got 3 roommates. Everyone had to pay 25%, but since my discount was 35%, I got to live rent free. And so that worked out great. They got a little bit of savings and I got to live for free, and spent several years in the property management space. So I really cut my teeth in multifamily, moved up from leasing manager to a property manager, did some development with the local firm. We bought land, got it entitled, built some apartments and leased them out, sold them. So I really have an affinity for multifamily. I probably spent the first 5 years of my career in some form or fashion working in multifamily. And so I saw the scale that comes with that. I saw some of the opportunity on the development side. And really, I learned how to deal with people in those roles. I worked low income housing tax credit all the way up to really high end Class A. So got a really wide spectrum of just some of the unique challenges and opportunities that multifamily provides. And during that time, I finished college. I got my real estate license, became a broker in Texas. I've had an active broker's license here in Texas since 2008. I've been licensed as a salesperson since 2006. So I kind of fancy myself still as a practitioner at some level. I have a small brokerage firm here that I run as a boutique here in Texas, and spent time in the valuation space. Got a lot of experience around just how to value a property, how the market interprets income and expense data, and then transitioned to my role here at TREP, where I live in the data 24/7. And so I've spent the last 23, 24 years of my working life in commercial real estate. I couldn't see myself doing anything else other than maybe teaching, which you mentioned. I teach at Texas Tech. I've been doing that for probably about 6 years at this point, but I've been teaching at the college level at the community college since 2013. So kind of have a heart for teaching. I really want to give back to some students that are up and coming and kind of share with them. Real estate isn't limited to just being a salesperson. There's There's commercial, there's valuation, there's lending, there's all these things. And where I sit at Trep now, I have a really diverse network of people. And so I try to help my students plug into some of that ecosystem. And so, that's me in a 45-second or 60-second nutshell. But I love this stuff. I live, eat, sleep, breathe commercial real estate. And I think I will until I'm not working anymore.
Oh, fantastic. That's great. By the way, you're not the only guest or first guest that talked about getting into real estate during college. I recall a guest we had did something similar, did investing in multifamily, small multifamily in college, until he decided he really didn't want to deal with people and decided to get into self storage, which I thought was kind of an
Well,
interesting path.
yeah, one of these days I'll write a book about some of the unique stories I have from property management. I mean, people live very differently, and some people are really not very clean, and things happen on sites that are just you can't imagine until you see it. So one of these days I might share some of that property management experience. It's a one of one career for sure.
Absolutely, it takes a special soul to be a property manager, particularly residential property manager. But there are people that enjoy it. They love the people contact. I also appreciate what you said about sharing multiple paths in the commercial real estate as part of your teaching. I often, and maybe we have some listeners, people are earlier in their career in commercial real estate, and I said, well, my 30-year career has been on the brokerage side primarily, touching on property management and other related services. There's a lot of paths to your point. There's valuation, there's lending, there's asset management. There's so many other paths for people who are not necessarily born salespeople. So great. It's really cool that you provide that kind of coaching or advice because I do the same thing. Hey, this isn't for you. There's other paths if you're just passionate about real estate as a whole. So
Yeah,
super.
totally agree.
Yeah, super cool in that. All right, so let's start at the macro level, if we will. As I said, you were our guest back in March, but let's forget about that. That was a long time ago. And let's just think about where are we in the commercial real estate cycle. I'll preface it by saying what my observation is, and we actually summarize this in our mid-year report for Coldwell Banker Commercial. Was we're starting to see deals happen. Not that deals weren't happening previous to that, but particularly with commercial real estate, when there's change, be it external factors, interest rates, whatever it may, is generally a kind of a lull in the market where sellers are kind of waiting for yesterday to return and buyers are waiting for the future to happen now, right? There's always this kind of period in the sales, particularly on the sales side, leasing as well, when just things kind of go quiet unless someone has to sell. Obviously, we've had some other news in the background with foreclosures and whatnot in some sectors. But what we noted in our report, and I think it was validated in the earnings report of the publicly traded commercial companies, is the market has started to turn deals, that the industry. So that's just my, kind of our armchair analysis. Lonnie, the guy who knows data, what are your thoughts on where we're at in the current commercial real estate cycle?
Yeah, I think you're spot on. I mean, I tell my students, and I preface most of my conversations with a couple of kind of overarching themes. Like one, I think real estate by definition, everyone understands or should that it's cyclical by nature. We know that. Usually cycles are 7 to 10 years. We were coming out of the great financial crisis before we had COVID and the challenges that were created with interest rates, et cetera. But we had a really long run of a bull cycle. So it's not atypical for things to kind of peak out and slow down. We've experienced that over the last couple of years. So that they're cyclical in nature, and we'll talk a little bit about where we are in that cycle. The other thing I point out is that real estate by definition is a local endeavor, sometimes hyper local. You can have two buildings on the same street that have two entirely different outcomes based on who the operator is, what the debt structure is, et cetera. And that plays itself out really visibly when the market slows down. When everything's running great and interest rates are low and capital's flowing like crazy, sometimes bad operators get masked and you don't really see the non-performance. It's not until things get really tough, leasing slows down, velocity slows down on the sales side, that some of those people that maybe are in a little bit over their skis get exposed. And so I think the last couple of years is where we've really seen the tide go out. And there's definitely been some people, that were ill prepared for what they were experiencing. But to your point, 2025 has been pretty strong. I mean, like we saw some signs at the end of 24 with originations across the CMBS market really picking up. We finished 2024 at 108 billion worth of issuance, which was the first time we'd been over 100 billion in several years, and it was a really strong statement for the market. Year to date, as of right now, when we're recording this, we're over 80 billion in CMBS issuance. Just to compare that to last year at this time was 67 billion. So last year was a very strong year, and we're significantly higher from an origination perspective. And origination is a great bellwether. If loans are getting originated, to your point, Dan, that means transactions are happening, whether they're refinance or they're sales. And so we're seeing a really strong origination market. The other part that I think gives like some support to this narrative of the market coming back is short-term bridge financing, the CRE CLO market. These are value add reposition loans. That market has taken off. The last 2 years, we saw in 2023 8.7 billion worth of origination total for the year. 2024 8.6 billion. We're already at 21 billion year to date in 2025. Now those are short-term floating rate deals where usually there's a value add or reposition. We sometimes will call them story loans. The operator has a business plan they're planning on executing. Those loans don't make sense if the lender and the borrower doesn't have some sense of being able to achieve the underlying business plan. So the fact that we're seeing a 3x multiple issuance this year, to me, gives me a sense of confidence that the participants, both lenders and borrowers, feel like we've turned a corner in the marketplace. And so some of the uncertainty around the election is long past us. We've got new uncertainty with tariffs and other things that we'll get into. But I think generally speaking, the market has adopted to the higher interest rate environment, and we're actually starting to see deals take place. And I'm bullish. I think 25 will finish even stronger, and I think 2026 is set up to be even a better year.
Oh, that's outstanding news, I guess. It was our observation as well, and I do think we have to position. I mean, it's a good year to be. I mean, I don't know. I never like to say it's a great year, but it's still relative. 2022 was a much better year overall. I think if I got the years right, right. So we're coming back. We're not back to that level, perhaps, but it's nice to see that lending's up. Frankly, part of the trouble in the market over the last year has been a little bit of, I'll call it restriction of capital flow into real estate, and it's nice to know that lenders of different sorts are deciding to approve investment or support for lending into different markets. Um, Let me just kind of was just wanted to plan to do this, but let me just how does that vary by asset class? I mean, do you want to just comment from it? Because I think it's important while the overall market looks in a positive direction for commercial real estate, what kind of variation, maybe to extremes, do you see between office, industrial, retail, hospitality, land, whichever ones you want to pick? Because there is that nuance of property type, asset class, and the recovery.
So it's a great question, and it's very interesting if you look at the data. About 22% of total origination volume thus far this year has been allocated to office, which just jumps off the page when you think about it. Like, we're seeing a resurgence in office. Now, the asterisk or the caveat is that it's 100% solely concentrated in the super high-end double A, highly amenitized, well-located, great tenant mix type of office. This is not holistic across the spectrum, all offices back open for business from a lender perspective. But if you're a high-end Class A office building in New York City or even San Francisco, you're starting to see an appetite for lenders really taking those assets and making large scaled loans across the spectrum there. So that's something we haven't seen in the past couple of years. New York jumps off the page. I think we've had 22 billion worth of office origination. About 13 billion of that has been in New York. So it's the clear winner in terms of resurgence. Now, San Francisco is in second place in terms of origination, which is really, really surprising in the sense that over the last 4 or 5 years, we've seen a huge pullback in San Francisco. Life quality of safety issues and some other things have really derailed not just the office market, but pretty much all commercial lending in San Francisco. They've got a new mayor in place. They've made some structural changes to how they're dealing with some of those issues, and you've seen the office market resurge in San Francisco. And to your point, Dan, nothing like it was pre-COVID, but still a really kind of a green shoot in that market. And so Miami continues to be strong across office. So office, I think, to me is one of the surprises, and I think we're going to start seeing a little bit lower down the spectrum, the B plus, the A minus properties starting to get picked up. I know there's a large lender here in Dallas, Hall Financial Group, that they had a big press release this week that they're now open for business for office lending. So I think that's a positive sign. Multifamily is really strong as well. There's been some negative headlines coming out of 2021 and 2022 around the Sunbelt markets and some of these short-term floating rate deals going bad. But on the whole, multifamily delinquency, when you look at Fannie, Freddie, CMBS, bank loans, is sub 2%. It's really low, and there's a lot of opportunity. We've delivered about 1.5, 1.6 million new multifamily units nationally over the last 2 years. That supply shock has largely worked its way through the system now. So that pricing power is really swinging back in favor of the property owners. And so I think for free market, non-rent regulated properties across the US, you're going to see multifamily be really, really strong in the latter part of this year and into 26. And then, maybe one cautionary tale, I think, and I've said this a little bit on our podcast, and the data doesn't quite support it yet, but I spend a lot of time on the road and I stay in a lot of hotels, and hotels have just not been kept up at a level that they should be because they were shut down during COVID. They used all their reserves to keep the mortgage current. They didn't invest into their project improvement plans. Fast forward to post COVID, they're getting all-time high RevPAR, room rates, ADRs. They don't want to take any units down to renovate because they're generating so much revenue, but the asset itself is tired. And so we have a lot of upcoming lodging loan maturities. If you underwrite the financial performance, everything looks great. But if you actually physically visit the asset, underwrite the asset, there's some hair on some of those lodging deals that I think will be exposed if we see a pullback in business travel, which with Doge and some of the other uncertainty, we're starting to see at some level. So overall, I think commercial real estate, even property sector by property sector, industrial still great, data centers great, everything is really strong. Hotels maybe are a little bit dicey at some level, but even then, nothing compared to what we've seen over the last 5 years.
One thing, Monty, I'll just, as you, with those comments, I was thinking that's sort of common between maybe all three of the classes, asset classes you talked about, is we're not dealing with an oversupply based on new construction in any of those classes. Like, past downturns had related in part to just oversupply, kind of like loose money, too much building. But clearly in the last 5 years, there's been very few new office buildings, and there probably won't be for a while, though I understand, if the demand gets high enough for Class A in some markets, there'll be some new construction, which would be great. But across the apartments, the same thing, right? The cost of construction, the cost of labor, the cost of money, right? All of that has sort of led to a significant slowdown in new product coming online, which in the long run, or I should say in the near term, will mean like probably upward pressure on rents, right? If there's not new supply. Is that fair to say?
Yeah, I mean, yeah, we're seeing that real time. I mean, this was the first time in the last 40 or 50 years where we've actually seen more offices being demolished than we've seen being added. And so there was a glut of office, and I think that's part of the challenge with the office sector is if you look at office broadly, and I know you guys are in Chicago, which has one of the largest, if not the largest, office market. New York and Chicago are right there. We never tore down any functionally obsolete office buildings. Like we just built new ones and left the old ones. And the challenge for office has been that they have an oversupply, not because of new construction, but just because they haven't demolished any of the old buildings. And so you're starting to see that through office to residential conversions, some deconstruction of office buildings, et cetera, kind of leveling off that supply and demand. But to your point, across the other asset classes, there's no oversupply. I mean, we saw retail was really the last asset class that had oversupply heading into COVID. COVID accelerated the demise of bad retail, and it really strengthened good retailers. And so they've got an equilibrium now, and you're seeing retail rents, vacancy at all-time lows, rent levels all-time highs. Maybe a cloud in the horizon might be some of the industrial stuff. I think we've built about 25 years worth of industrial spec space in the last 7 years or so. But that is an industry that hadn't seen any construction for many decades on a relative basis. And so, you know, maybe we're starting to see a slight pullback there, but to your point, there's not any category where I see just massive oversupply. If you wanted to go really far down the chain, you could maybe say post-COVID with some of these self-storage and tertiary markets, there was a run up at one point where mobile home parks and self-storage had kind of become kind of the alternative class favorite, where everyone was like, the yields have been pushed so much that they couldn't make money in some of these more predominant classes. So you started seeing folks push outside of the norms and go to self-storage or mobile home parks outside the tier two and higher cities. But it's a rounding error relative in the overall CRE landscape, and even those markets, it won't take that long for them to hit equilibrium. So I think we're in a really strong space. I mean, that's the the great thing about commercial real estate is, if anything, through this most recent upheaval with COVID and now the interest rates, it's just proven how resilient of an asset class it really is from an investment perspective.
Yeah, absolutely. I think, if there's anything, and maybe you'll cover it on one of your podcasts, is I worry a little bit about that 1980s, 1990s vintage office space. I just saw some assets trade in the suburban Chicago market that, wow, what would have been really nice suburban office park buildings at one time that might have sold for 5 million or selling for 1 million, like the price of a house. Right. But then again, generation, those are 30, 40-year-old assets, right? And the type of space, locations changed. So, probably that's just part of the cycle. So that's the only segment that I've seen. And even in the downtown here in the market, some of the 1980s, 1990s, they've traded at, 30 cents on the dollar from the last trade, which is, in my view, it's unfortunate for the investors, right? But it's actually good for the market. Reprices the asset. Someone can come in with a new concept. Even if they are going to continue the use of office space, they can at least price it at a point that's competitive in the market. They can put money into TIs and capitals to refresh the building and so forth. So I guess that's the what I see in the market, at least for one segment of the office space.
Yeah, I think that that point gets undervalued in the market headlines is when we go back to me saying the market's cyclical by definition, like without government intervention, that's exactly what happens. When people overlever the property and they can't afford to maintain it and they can't get the tenants and they can't put TIs in, to your point, the investors that own the building suffer the consequences of a loss. But that reset basis creates opportunity for the new owner to come in and reinvest in the building and keep it viable. And that's the part that we really post GFC, where we've had so much stimulus and intervention. We haven't seen that part of the equation fully play itself out. And even with this most recent disruption, I mean, there's a lot of shadow distress of office properties in the market. But if you look at delinquency as a whole, right now, office is sitting at about 11% delinquency in the CMBS market, which is an all time high. But that means 89% of the offices are still making the mortgage payment on time. And it's just really interesting to see how that will play itself out. I agree with you. I think for a lot of these Class B offices, the highest and best use is still an office, but it's at 50% of the current basis. And if someone can come in and buy it for 50 cents on the dollar, they can run it at 70% occupancy and still cash flow. And so it's just that capitulation. Is the lender being willing to take the loss, the LPs getting wiped out? Like, everyone wants to fight for that last penny of equity, and they should. They have a fiduciary obligation. But the reality is a lot of these deals just won't work at the current leverage. And it's, when will we see that rollover start to happen? And I think we're starting to see it at some level. We've seen CIBC sold a big office portfolio at about a 9% loss. We're going to see some other banks start to strategically divest from some of their non-performing assets. And hopefully for cities like Chicago, which we need as a country, we need it to be a vibrant commercial real estate marketplace. I'd love to see all those, non-performing loans sell at 60 cents, 50 cents, 30 cents on the dollar. And 2 years from now, we're talking about how strong the Chicago office market is, because I think at some level, that's all it's going to take.
Yeah, it makes sense. Of course, I do too. When I go downtown, I kind of, long for the days of the busy streets, and life changes. Things do change in phases, but I know 2 North Riverside Plaza, 311 South Wacker, Merchandise Mart is on the market. Some have traded. That's, again, in my mind, that's good news, right? Those buildings have got to trade in order to kind of restart the market. But anyway, enough of the local news. Why don't we go up to the national level? As I was said at the early part of the podcast, since you presented in March. Boy, we have endless news on tariffs. I mean, every day of the week is a little bit of a new day. So that's one thing. I haven't, we work. I guess the Fed is kind of waiting to see the impact on inflation. That obviously has some bearing on interest rates and obviously commercial real estate. Therefore, but also just the big beautiful tax bill. There was a lot in that. Frankly, a lot for commercial real estate in terms of depreciation and some other things. So why don't we go up to the the kind of high level, and just why don't you give us some thoughts on how some of those emerging or past federal level legislation is changing the market for commercial real estate today.
Yeah, I mean, the big beautiful bill, regardless of which side of the aisle you sit on, if you're in real estate, it's positive for the industry because it locked in bonus depreciation. It locked in and secured the 1031 exchange is effectively continuing as it has been established. And it just creates all kinds of tax incentives and other things for commercial real estate development and investment. Opportunity zones were locked in and extended. All of these things are a net positive for commercial real estate. So I think for, all of the other outside noise around tariffs and interest rates and all the challenges that are very real, there was a little bit of solace in the fact that with this new legislation, some things that really drove investment activity. Bonus depreciation was one that, during 2020, 2021 was used at scale and really helped people make some investment decisions and maybe move forward in some transactions that they otherwise might not have. Having that codified now, I think really gives some credence to people getting their money deployed back into commercial real estate. And then 1031 exchange is an interesting construct because at this point, 1031 exchange, the only asset class that still remains is commercial real estate. And there are a ton of downstream benefits of the 1031 exchange. So for maybe the listeners that aren't as familiar with what that is, it's a tax deferral where if you sell a property, you can do a like type exchange. You have 6 months to identify and procure a new asset. You basically take your capital gains from the sale of the first property, roll them into the new property, and you get to defer the gains tax on that. And a lot of people say, well, I don't understand why that's beneficial because it would be better if they just paid the tax on the sale. But as we just mentioned, if you roll your proceeds into a new deal and you have to invest capex or TIs or other things, you're hiring local contractors, you're stimulating that local marketplace, you're creating new jobs for people. That reinvestment cycle actually is a net positive for those local economies. And there are a lot of institutional players that do this at scale, and it creates some real good tailwinds for those local economies. So I'm a huge fan of the 1031. And so I think broadly, the legislation is very positive for commercial real estate. And the opportunity zone is another one. Like I was 2018, 2019, I think is when that first got kicked off. And there was a ton of excitement and hoopla around opportunity zones, but nobody fully understood it. And there was this drag at the end, I think, where the legislation wasn't fully baked to where you knew for sure it was going to get continued. And so that kind of kept people from investing in them. But now that's solidified. And so you're going to see a lot more capital, in my opinion, being deployed into these areas that have been defined as needing investment. There's favorable tax treatment through the opportunity zones to invest capital in those markets. And it's going to really stimulate, I think, some of that new construction that we said was lacking just a moment ago. So all in all, from a real estate perspective, taking the politics out of it, the big beautiful bill, I think, is very favorable for commercial real estate investors.
Yeah, I mean, policy will change. Irrespective of party in the administration, policy does change over time, and it's important just to understand how it impacts commercial real estate. To your point, it sounds like protecting the 1031 wasn't addressed in the bill, as I recall, but making sure that it stayed protected, so to speak, as well as opportunity zones are two things that you're really focused on. And, I'd also, while larger investors do take advantage of both of those tax advantages, a lot of the 1031s is used by private investors, right? It's very, very common. So, we probably have more private investors than institutions that listen to this podcast. And I'm sure there's many people that have taken advantage of the 1031 provision. Not to mention things like, the different kinds of depreciation you could do on an asset and things like that, which are also protected or expanded in the tax bill. So I think what you're saying and what I've seen as well is it should be good for commercial real estate, right? Cool.
Yeah, 100%.
Yeah. So we talked about different asset classes, and we did go up to the 30,000 foot level and talk about the national. But let's think a little bit or discuss a little bit about geographic differences. For our Coldwell Banker commercial network, a lot of our presence is in secondary and tertiary markets, where I don't know by nature they don't tend to seem to have the highs of the large cities, but they also don't have the lows. And to the point earlier, we talked about recovery. We've seen recovery more in the digit percentage, just in terms of transaction volume, where some of the large cities you mentioned, San Francisco, New York, are saying higher. Totally makes sense. But where else do you see geographic differences in the recovery, commercial real estate recovery, as we move into the second half of the year or potentially into 26 as well?
Yeah, so I think you make a very strong point. You guys know this better than anyone because this is a market you serve, that kind of second tier, tertiary market that maybe doesn't see the super high highs, but don't see the super low lows. I think the Midwest region has really typified that over the last 10 years or so. They haven't seen significant double digit rent growth across the spectrum of different asset classes, but they haven't really been negatively impacted across this downturn or disruption like some of the other markets have. And so you look at some of those Midwest states across multifamily, across industrial, and you've seen, some really strong performance there. We've had a few folks on our podcast where their entire investment thesis over the last 10 years has been to buy Class B multifamily in Midwest markets where, you actually can have renters afford to pay the rent every month. And guess what? When they can afford it, they pay every month. And so you have strong occupancy, you have strong rent collections. That leads to just better investment opportunities across the spectrum. Then your retailers and your restaurants and all of those people have a core foundation to build off of that they can invest capital into those asset classes and benefit from it. So it's really interesting. I think a lot of us in the CRE space, we get enamored with the headlines sometimes, and the headlines, to your point, usually track the gateway cities. You're going to hear about San Francisco and LA and Dallas and Chicago and New York. But in practice, I mean, that you can count those cities on one or two hands. It's all the other cities that actually make up the strength of the marketplace. And so, and it's local investors, like you mentioned, it's not the institutions. Obviously, institutions get the headlines, but for every institutional transaction, you have some multiple of local investors transacting on properties. And so I think where markets that are experiencing the benefits of just the strength of those local economies, most tier two cities. Now, some of them got really inundated with COVID, where they had a lot of mass in migration or net in population, where they had people moving from big cities to there. You look at Idaho as an example, Boise. You look at Salt Lake as another example, where you just saw this huge influx of population, which really pushed rents and pushed things outside of equilibrium. And now that people are maybe moving back to their primary residence, or they decided that small town life isn't for them, they've seen some challenges. Charlotte might be another example of that. But generally speaking, you know, we've seen in practice, we've had multiple people on our show where I've interviewed them and they've said, sometimes in commercial real estate, especially in retail, let's take retail strip malls as an example. A lot of people love the concept of having national, long-term leases in place with credit tenants. As soon as the COVID disruption happened, those national tenants sent legal letters to all of their landlords and said, we want to stop paying rent. And the challenge, if you're an owner of that center, is you probably have a disproportionate amount of your rent coming from credit tenants. And when they make those demands, you're in a really tough spot. In these secondary cities, you might have a local nail salon and a donut shop and a dentist and people that like make their livelihood out of operating those facilities. And so when COVID happened, as an example, they showed up to work and they tried to make sure that they continue to protect their business. And if you own the real estate, you actually benefited from having non-credit tenants in the location where people's lives were tied to the success of their companies. And so, I'm a huge supporter of these secondary markets where I think the actual headlines fade and people show up to work every day, and the local economies benefit from that. The real estate investors benefit from that, and it actually creates unseen opportunities. And so what's really interesting is over the last couple of years, we've seen a lot of capital go into those markets. I think because people are finally realizing I might be able to get a little less yield on an IRR calculation, but I'm actually going to have an easier time of managing. I'm going to have an easier time to backfill these spaces if someone does move out. And that local economy, like the neighborhood feel, the family concept, is a much stronger place to place my capital for good results versus competing with all of the name brand credit tenants in these super sophisticated markets.
Yeah, it makes sense that geographic variation makes sense. I think there's one other thing, and maybe it's for a future podcast of your own, but I've read some about just changing preferences of demographics. In other words, for example, older over 65 preferring to rent at a higher rate than they did in the past. So that's kind of an interesting thing for apartments. And also perhaps I don't know if it's millennials or the generation after who maybe have given up on the idea of buying a home, or maybe they say like, "Yeah, what the heck? Renting's just fine." And then you get used to it, right? And I do think that's for the apartment market. Then there's also a side benefit to related retail and so forth. That could be a trend in the I'll call it near future, right? Those people can change their mind, but some of it's still memories of the great financial crisis. Perhaps the retirees going, "Hey, I lived through that. I don't want to do it again. I'll just be safer to keep my money in CDs and rent or whatever it may be." And the same with the millennials who might be the children of those people, right? Who are retiring and suddenly. So anyway, that's just a side thing, but I think there is something about the demographics in general, right? That that's also impacting at least a portion of the retail and the multifamily market as well. So
Yeah, I
geography is
think
one, but demographics
yeah,
is one.
I think it's this marriage of geography and the social components of real estate.
Right, there you go.
For like where you mentioned certain people just don't want the maintenance and burden of owning something, whether they can afford it or not. They'd rather rent and have someone else have that burden. And we've seen this play out with the proliferation of build to rent neighborhoods. So you have these new home developers that are actually just building entire neighborhoods with the prospect of renting the properties out. You maybe shake your head and say, why are they doing that? And the reality is people will pay a premium to have a separate standalone, um, single detached residence versus an apartment. And they actually will stay in that longer because they get all of the benefits of home ownership without any of the responsibilities. Now, we could talk back and forth on whether we think that's net positive for the markets or negative or whatever, but there's definitely people are tapping into that demographic shift that you've identified because there's definitely among the buyer pool, some people would rather just rent, and they're completely happy at doing that. And the development community has taken notice of it, and we started to see a lot of new developments that leveraging those changes. And so, for me, you could argue you're not creating equity or whatever, but if you're spending less on rent, I mean, I saw a stat a couple of months ago that was the delta between renting and buying in the U.S. was about $1,200 a month cheaper to rent than buy. So you could make a really strong argument that if you invested the difference, you could actually end up in a better spot at the end of your working life, having invested that $1,200 a month versus owning a home that has maintenance and other costs associated with it. So it'll be interesting to see how this plays out, but I definitely have picked up on that as well. It's a good observation.
Yeah, I think there's also a habit. What I mean by that is, during COVID, people got used to being footloose and, in using some of the, not just saving for the future, but just using those resources differently. Yeah, I want to go live in Portugal for a month, right? And I can do that a lot easier if I'm renting, perhaps than owning a home. But anyway, that's maybe for another podcast in depth. As we've covered a lot of things, but why don't you just give us some thoughts on 2026? It sounds like in general, you validated what we observed as the market's in recovery, commercial real estate market's doing well. There's some variation in geography and asset classes, but what should we be thinking about as we look forward to 2026?
So I think, as I mentioned earlier, that the end of 25, beginning of 26, I have a very strong, conviction that the markets are going to be strong. This is all, caveated that we don't see some geopolitical or global challenge or something like that that's unforeseen, which used to happen once every 100 years, it feels like, and now happens like once every 2 weeks. Unfortunately, we live in this information overload society now where things that literally would derail the stock market or put things on hold now like barely make the Wednesday night news. It's really remarkable to see how that's shifted. But notwithstanding any substantial changes, I think the higher for longer narrative has become the higher for longer reality, and the markets have adjusted, and I think they'll continue to adjust, and we'll start to see, as I mentioned, some of that strategic divestment of some of these non-performing assets, which should act as a catalyst for more transaction velocity and volume. The only potential, headwind I think that we might see in the near term and in the first part of 26 is the tariff policies that have been enacted have fluctuated. We've seen extensions, we've seen selective enforcement of tariffs, etc. Once that kind of dies down and it becomes, known like what is actually going to be in place, it takes some time for those tariffs to actually work their way through the system. So, I'm a deal maker. I'm a CRE guy. Our chief economist, Rachel Samansky on our team, she's cautioning me every week, like, tariffs take time to work through the system. Because if I look at the data now, I'm saying all these folks that are doing deals, like, they're acknowledging the tariffs are there, but they're still pushing forward. And she says it's probably going to take 6, 7, 10, 12 months before those tariffs are fully baked in. And then we'll see how the impacts are across the transaction market. So if those tariffs get implemented at scale and they actually do increase, aluminum and steel and copper and cost at a level that they're anticipated to, I do think you could see some measured pullback in the market. But overall, it's really strange, Dan. If we look back, COVID was now almost 6 years ago. It feels like it's 12 months ago, but it's been 6 years. You've had the interest rate, the Fed raising rates 500 basis points over an 18-month period, which was unprecedented. We've really lived through about 25 years worth of challenges in the last 5 or 6 years. and the market has performed exceptionally well. So if things level off and calm down, I don't see any reason why they won't be even better than they've been. And so I'm optimistic heading into 26, pretty much across all asset classes. Data centers, I think, are interesting. Um, the reality of the utilities they consume, the power from the electrical grid, and the water consumption that they require. I think now that there's enough of them being built at scale and local municipalities are getting a taste of that, that's something that's gonna have to be debated and kinda worked out. There's gonna be some real pushback from local homeowners and others that are being asked to ration their water so they can keep a data center online, like, that's gonna be challenging. Um, Industrial broadly, maybe some pullback in the sense that I don't know how much longer rents can continue to go up on the industrial space, like, at some point, you gotta see that natural cycle start to play out and cooling off. But overall, I see a lot of really strong tailwinds for commercial real estate. I think 26 will be a really banner year for us.
Well, that's obviously music to my ears, so I'm going to keep my fingers crossed. Yeah, there's always, you know what? Someone's made a comment on a podcast I listened to yesterday. There, it seems like in our industry and in business in general, there is always an external shock. There is always something, right? So it's a matter of how the market adjusts to it and how we react to it, right? To your point, there is a headline every 10 minutes on your phone about something that could be catastrophic that might turn into nothing. I think to your point, I think I've observed the same thing that commercial real estate markets in general and the economy, frankly, US economy in general, has held up really well. Despite the interest rates, despite, tariff news, geopolitical issues and so forth, the consumer, there could be some weakness here and there, but by and large, the economy's held up. So fingers crossed for that, right? Continued success in that, because if there's demand for in the economy, there'll be demand for commercial real estate. And as we discussed, with somewhat limited supply across some of the asset classes, that should bode well for property owners. And to your last point about data centers, just to give a plug to my hometown geography, the Midwest should do well. If we have enough power, we've got plenty of water. So if we don't have natural disasters to the same extent that Florida and Texas, some other places have, right? It should bode well for being a hub of data centers like. The Midwest has been a hub for transportation and other things over many years. But anyway, I appreciate that outlook. Considering it's a positive outlook, and I totally think it's a great way to end our podcast. I really appreciate Lonnie being a guest today. I think you were pretty positive when you spoke in March. I think there was a little bit more uncertainty then because some of these policy things hadn't come to fruition yet. But Lonnie, thanks for being a great guest, and thanks for kind of talking to us again and to all of our listeners on our CRE with CBC Worldwide podcast.
Yeah, thanks for having me. Had a blast joining you, and would be happy to come back anytime.
Yeah, I
So
appreciate that. I think some
thanks
of the
for the
key
time.
takeaways I've had in this podcast are, first of all, there's some reason for continued optimism. So that's one. Secondary markets, we are in as a brand, we're in a lot of secondary and tertiary markets, and there's a reason to feel positive about those markets from a commercial real estate standpoint. And I guess the resiliency of the economy and the commercial real estate sector is doing really well. So appreciate that. As I mentioned earlier, Lonnie is the host of the Trepwire podcast. You can catch him on Thursday on the Trepwire podcast. That's for one. How else would you like people to get in touch with you? Through LinkedIn? I also know you're on X. What is your preference?
Either one, you can connect on LinkedIn. You can find me on X. I'm just at Lonnie_CRE. Or you can find me on the Trep website. I love to connect, love to interact. If there's anything I can do to help provide color or clarity to maybe your local market or whatever, we like to do that at our convenience and try to help people make more money and find more deals. So whatever I can do to help, happy to have people reach out.
Fantastic. Well, thank you again for being our guest today. That's a wrap on today's CRE with CBC Worldwide podcast. A big thanks to Lonnie Hendry, our guest today, for sharing his insights into current market conditions for commercial real estate, as well as a positive outlook for 2026. If you've enjoyed today's conversation, be sure to follow our podcast on Apple or Spotify or wherever you listen to podcasts. And leave us a positive review. It's those positive reviews that gets more people introduced to the conversations that we have on the Coldwell Banker Commercial podcast. For more episodes and resources, visit the cbcworldwide.com website. And I'm Dan Spiegel. Thank you very much for listening, and we will see you next time.